Can the average American still afford a home in 2025? The truth is, alarming millions are struggling to keep up with mortgage payments, rising property taxes, and skyrocketing living costs. Across the country, families are facing a mortgage nightmare where the dream of homeownership is slipping further out of reach. And it's not just about big cities like Las Vegas, Miami, or Phoenix, even suburban areas are seeing foreclosures rise and rents spike. In this video, we'll explore why Americans are finding it harder than ever to afford a home. We'll break down the numbers on foreclosures, interest rates, and investor-driven markets, and show how rising inflation and stagnant wages are creating pressure on households nationwide. From cost of living increases to housing supply shortages, the factors are converging to form a perfect storm for homeowners and renters alike. You'll hear real examples of families who are paying far more than recommended, sometimes over 30–40% of their income, just to hold onto a roof over their heads. We'll also explain how policies from the Federal Reserve, coupled with massive hedge fund and REIT activity, are influencing prices and accessibility across the country. By the end of this video, you'll understand the scale of the crisis, what it means for you and your community, and how to prepare. This is the mortgage nightmare no one is talking about, but everyone is living through. The mortgage crisis isn't just a local problem, it's spreading across the entire United States. From Florida to Texas, Arizona to Nevada, families are struggling to make ends meet as foreclosures rise and home prices soar. In many regions, households are paying 30–40% of their income on mortgages alone, far above the economists' recommended maximum of 30%. This leaves families with little breathing room for utilities, groceries, insurance, and other living expenses. Take Florida, for example. Cities like Miami and Orlando are experiencing spiking foreclosure rates, and many homes sit on the market unsold for months. Arizona suburbs aren't faring much better, with newly built homes priced out of reach for middle-income families. In Texas, metro areas like Houston and Dallas are seeing intense competition, with buyers forced into bidding wars that push prices far above affordability levels. Even Nevada, dominated by Las Vegas, mirrors this trend. The Strip's economic fluctuations have direct consequences for local housing, leading to fire sales and desperate attempts to stay afloat. These challenges aren't limited to major cities. Suburban areas and smaller towns previously considered affordable are now feeling the squeeze. Families who bought homes years ago at reasonable prices are now facing negative equity, where the home's value drops below the mortgage owed. Young Americans, particularly millennials and Gen Z, are entering the market later, saddled with student debt and stagnant wages, and finding that even modest homes are no longer attainable. The pressure is compounded by the fact that mortgage rates, although lower than historical highs, are rising in many regions. A mortgage that seemed manageable just a few years ago can now cost hundreds more per month, especially when paired with inflation and rising costs of living. Families across the nation are being forced to make tough choices, cut spending, take on additional jobs, or risk losing their homes. The lesson is clear: this is not a crisis limited to one city or one state. The mortgage nightmare is a nationwide reality affecting homeowners and renters alike. Every American household must be aware of the financial pressures and market conditions, because the ripple effects of foreclosures, rising rents, and investor-driven property acquisitions are only going to intensify. Understanding the scope of the problem is the first step to preparation. By examining what's happening in states like Nevada, Florida, Arizona, and Texas, viewers can gain a clear picture of the challenges facing millions of Americans today and start considering strategies to protect their financial future. Now that we've seen the widespread mortgage pain across America, it's important to understand why affordability is crashing. Unlike the 2008 housing crisis, which was largely caused by reckless lending and subprime mortgages, today's crisis is driven by rising living costs, stagnant wages, and inflation. Mortgages are being carefully vetted by lenders, meaning homeowners are qualified to borrow based on real income, yet many still struggle to keep up with monthly payments. One major factor is inflation. Prices for essentials groceries, gas, healthcare, utilities have steadily increased over the past few years, even if your mortgage hasn't changed the money you have. To cover everyday expenses leaves less room for your home payment. Property taxes and HOA fees are also rising in many regions, adding thousands of dollars annually to housing costs. Families that were once comfortable with a mortgage of $1,500 per month now face payments of $3,000 or more, consuming 30 to 40% of household income, far above the recommended threshold. Stagnant wages exacerbate the problem. While prices climb, salaries for many Americans have not kept pace. This creates a situation where even for households earning the median income of around $75,000 per year, maintaining mortgage payments alongside rising living costs becomes a challenge. The result is that families are forced to make difficult choices, cutting back on essentials, taking on additional work, or risking foreclosure. The role of interest rates cannot be overlooked. Rates that were once historically low have started to rise, meaning new buyers face higher monthly payments. Combined with housing supply constraints, particularly in fast-growing states like Florida, Texas, and Arizona, the market is increasingly unaffordable. This affects not only homeowners, but also millennials and Gen Z renters who are seeing entry-level homes priced far above their budgets. Another factor is the influence of investors and institutional buyers. Hedge funds and REITs purchase homes in bulk, often paying above market value, which drives up prices for everyone else. The so-called rate lock trap keeps existing homeowners from selling because they would have to replace low-rate mortgages with higher-rate ones. This leaves inventory stagnant, prevents market corrections, and keeps prices inflated. The combination of rising costs, stagnant wages, interest rate increases, and investor competition forms a perfect storm. Families across the nation are trapped in a cycle where mortgage payments are unsustainable. Homeownership is increasingly out of reach, and renting becomes the only viable option. Even middle-class Americans who previously thought homeownership was achievable are now struggling to secure affordable housing. In summary, affordability is crashing because the financial pressures on households are intensifying faster than solutions can appear. This isn't just a local or regional issue, it's a nationwide phenomenon. Understanding these underlying factors is crucial for anyone trying to navigate today's housing market. Whether you are a homeowner, a renter, or planning to buy, knowing why affordability is collapsing will help you make informed decisions and prepare for what's coming. Beyond affordability, market forces and investor behavior are playing a major role in the mortgage crisis. One of the most significant factors is the influence of the Federal Reserve. Recent interest rate cuts have lowered borrowing costs not just for families, but for hedge funds, private equity firms, and REITs, real estate investment trusts. These institutional investors are now purchasing homes in bulk, often outbidding individual buyers, and creating a competitive environment that drives prices even higher. In cities like Las Vegas, Miami, and Phoenix, investors control a significant portion of available homes, reducing inventory for everyday buyers. This trend has led to what analysts call the rate lock trap. Homeowners who bought properties with low mortgage rates years ago are hesitant to sell because any new mortgage would come with a much higher interest rate. The result is stagnant inventory, inflated housing costs, and fewer opportunities for first-time buyers. The melt-up scenario is another consequence of these market forces. As institutional investors continue to purchase real estate, asset prices rise sharply. Combined with stagnant wages, this creates a situation where the average American is priced out. Even those who can technically afford a mortgage find that the competition and high prices make homeownership increasingly difficult. Investor activity also impacts rental markets. Many homes acquired by hedge funds and REITs are turned into rentals, often at premium rates. While this may seem like an alternative for buyers who can't afford to purchase it, puts additional pressure on renters. Families are paying high rents for modest homes, sometimes $2,000 to $2,500 per month, consuming a large percentage of their household income. This investment-driven dynamic is not limited to one city, it's a nationwide issue. In Florida, hedge funds are snapping up condos and single-family homes. In Texas, institutional buyers dominate fast-growing suburbs. Even smaller cities are feeling the pressure as investors increasingly look for markets with high demand and potential appreciation. Ordinary Americans are now competing against sophisticated investors with deep pockets, creating an unequal and challenging housing market. Furthermore, the combination of interest rate policies, inflation, and investor purchases reinforces negative equity risk. Homes that may have once been affordable now hold the possibility of losing value, leaving owners underwater and limiting mobility. Families that bought at the peak may struggle to sell without accepting significant losses. Meanwhile, prospective buyers face a market where prices continue to climb further, deterring first-time homeownership. The key takeaway is clear: the mortgage crisis is not solely about individual households' ability to pay. It's about systemic market pressures, policies from the Fed, and the increasing dominance of investor-driven housing markets. Understanding these forces is essential for anyone navigating today's housing landscape. Families must be aware of not just their income and expenses, but also the broader economic and investor dynamics that shape affordability and access to home ownership. Las Vegas may illustrate these trends vividly, but the underlying market forces and investor impact are felt across the country. Recognizing these dynamics equips viewers with the knowledge to make smarter decisions, whether they're considering buying, renting, or simply preparing financially for the coming months. While homeowners are facing increasing challenges, renters across the U.S. are feeling the squeeze just as severely. Rising home prices coupled with limited inventory and investor purchases have caused rental rates to climb, often outpacing wage growth. Cities like Las Vegas, Miami, Phoenix, and Dallas are seeing families pay $2,000 to $2,500 per month for modest two-bedroom homes, which consumes a significant portion of their monthly income, leaving little for savings or emergencies. This national trend disproportionately affects millennials and Gen Z, many of whom are entering the workforce burdened with student debt. These younger Americans are finding it nearly impossible to transition from renting to homeownership. Even those who can afford to rent must navigate strict credit checks, large security deposits, and income verification that favor higher-earning or more established tenants. The result is a growing population trapped in long-term rental arrangements, unable to build equity or wealth through property ownership. The implications extend beyond individual households. Communities are feeling the strain as high rental costs reduce disposable income, affecting local businesses and slowing economic growth. Families spending a larger share of their income on housing cut back on discretionary spending, from dining out to local entertainment, which can create a feedback loop that depresses the broader economy. Institutional investors exacerbate these issues. Hedge funds and REITs that purchase homes in bulk not only reduce the number of homes available for purchase, but also set rental prices at a premium, taking advantage of supply scarcity. This investor dominance transforms the housing market into one where ordinary Americans are competing against deep-pocketed organizations, limiting access to both ownership and affordable rental options. Negative equity is also a growing concern. Homes purchased at inflated prices may lose value if the market corrects, leaving both homeowners and renters in precarious positions. Families that might have planned to purchase their first home find themselves priced out indefinitely, while renters face continuously rising rents with no relief in sight. Moreover, the crisis underscores the geographic disparities in housing affordability. States that saw population booms post-COVID, like Florida, Arizona, and Texas, now experience extreme competition for both homes and rentals. Even smaller towns that were historically affordable are becoming increasingly inaccessible as investors and market forces drive prices upward. The key takeaway is clear: the mortgage nightmare is only one part of a larger housing crisis that affects renters, first-time buyers, and even middle-income families. With inflation, stagnant wages, and investor-driven markets, the gap between what people earn and what it costs to live in a home is widening. Families across America must contend with high rents, limited options, and a shrinking path to home ownership. Understanding this broader context is essential. It highlights that the challenges seen in Las Vegas are not isolated, but symptomatic of a national trend. Renters and potential buyers alike must be aware of market forces, monitor interest rates, and understand the implications of institutional investment in housing. Preparing financially and strategically is now more important than ever if Americans hope to navigate this unprecedented housing landscape. Now that we've explored the struggles of both homeowners and renters, it's time to focus on how Americans can survive and prepare in this mortgage nightmare. The first step is financial assessment. Understand exactly how much of your income goes toward housing costs, including mortgage or rent property taxes, HOA fees, insurance, and utilities. Experts recommend keeping housing costs under 30% of monthly income, but for many families, this threshold is already exceeded. Knowing your numbers is essential for making informed decisions. The next step is increasing income and building financial resilience. This could involve side hustles, freelance work, gig economy jobs like DoorDash or Uber Eats, or selling items online. Even modest additional earnings can provide a buffer for rising mortgage or rent payments and unexpected expenses. Building an emergency fund is equally critical. Having a few months of expenses saved can prevent foreclosure or financial distress in volatile markets. Improving and maintaining a strong credit score is another key strategy. A good credit profile can make the difference in securing favorable mortgage or rental terms. It also provides flexibility if refinancing or negotiating terms becomes necessary. Regularly monitoring your credit report and addressing any errors can save significant costs over time. For those planning to buy a home, patience is crucial. Monitor the market closely for price reductions, interest rate adjustments, and inventory changes. Avoid rushing into purchases out of fear or market hype. Be aware of the rate lock trap, where homeowners with low existing mortgage rates may delay selling, keeping prices artificially high. By waiting for market conditions to stabilize, buyers can reduce the risk of negative equity, where the home value falls below the mortgage owed. Renters can also take proactive steps. Negotiate leases where possible, stay informed about local rental markets, and prepare for strict vetting, including credit checks and security deposits. Understanding rental dynamics helps families secure housing without overextending financially. Additionally, staying informed about macro-level factors, including Federal Reserve policies, interest rate changes, and economic forecasts, is essential. The coming months may bring further rate cuts or increases, impacting both mortgage affordability and rental costs. Awareness allows families to plan, whether that means waiting to buy, adjusting budgets, or seeking alternative income opportunities. Finally, cultivate long-term financial resilience. Reduce unnecessary spending, diversify income streams, and explore ways to build wealth outside of traditional homeownership. Education investments and skill building can all provide additional security in an unpredictable market. Even small steps like flipping items online or taking short-term investment courses can have meaningful impact over time. In summary, surviving this mortgage nightmare requires preparation, patience, and strategic action. Budget carefully, increase income, maintain credit, and monitor the housing market closely. The crisis is real, affecting both homeowners and renters nationwide, but proactive planning can help families navigate these challenges. Las Vegas and other high-pressure markets serve as a warning, but with knowledge and preparation, Americans can protect their financial futures and make informed housing decisions. Understanding the forces at play, rising costs, inflation, investor activity, and interest rates equips you to survive and even thrive despite the ongoing mortgage nightmare. Before we wrap up, let's focus on practical solutions and actionable steps that can help Americans survive and even thrive during this mortgage nightmare. First, review your budget carefully. Calculate all housing-related costs, including mortgage or rent property taxes, HOA fees, insurance, and utilities. Knowing exactly how much you spend monthly helps identify areas to cut back and ensures your housing costs remain manageable, ideally under 30% of your income. Next, consider increasing your income through side hustles, freelance work, or gig economy opportunities like Uber, DoorDash, or online marketplaces. Even modest additional earnings can provide a buffer for rising costs and help you avoid financial stress. Emergency savings are critical. Aim for at least 3 to 6 months of living expenses in a readily accessible account. This fund can prevent foreclosure or rental crises if unexpected expenses or job disruptions occur. Improving and maintaining a strong credit score is equally important. A higher credit rating can secure lower interest rates, better mortgage or rental terms, and greater flexibility in refinancing. Regularly review your credit report and correct any discrepancies to maintain optimal financial health. For those considering buying a home, patience is key. Watch the market for price adjustments, interest rate changes, and inventory availability. Avoid rushed decisions out of fear and be aware of the rate lock trap selling a low-rate home. Today could force you into a higher-rate mortgage. Strategic timing can protect you from negative equity and ensure a more secure purchase. Renters can also take proactive steps, negotiate leases, understand rental market trends, and be prepared for vetting requirements like credit checks or security deposits. Being informed helps secure housing without overextending financially. Finally, educate yourself about the broader economic forces affecting the housing market, from Federal Reserve policies to investor behavior. Knowledge empowers you to make smart decisions and reduces the risk of being caught off guard by market fluctuations. The takeaway: preparation, strategic action, and financial awareness are your best defenses. By implementing these solutions, now you can mitigate the impact of rising costs, protect your household, and navigate the mortgage nightmare with confidence. To wrap things up, the mortgage nightmare is a reality impacting millions of Americans nationwide. From Las Vegas to Florida, Arizona to Texas, families are struggling with rising mortgage payments, soaring rents, and increasing living costs. Homeownership is harder than ever, and many are forced into long-term renting. The combination of investor-driven markets, inflation, and stagnant wages has created a situation where affordability is under severe strain. But there's hope. By taking proactive steps, budgeting carefully, building an emergency fund, increasing income, and maintaining a strong credit score, you can protect your household and prepare for opportunities when the market stabilizes. Staying informed about interest rates, housing trends, and investor activity is crucial to navigating this challenging landscape successfully. Subscribe to this channel to stay updated on mortgage news, housing crises, and economic developments across the United States. With knowledge, preparation, and patience, you can make informed decisions about buying, selling, or renting and avoid falling victim to financial pitfalls. Remember, the mortgage nightmare is not just local, it's nationwide, and your financial future depends on being proactive. Take control. Now, prepare strategically and position yourself to navigate the coming months with confidence. The mortgage nightmare is real. Are you ready to act?